Okay, everybody. Hope you're having a great day in the neighborhood. All of your submissions have been graded. All your exams have been graded. Everybody did really good. There was one person that made a two on something because I was like, I couldn't even tell what y'all were talking about. It was like two sentences to an answer, and I'm like, I don't even know what you're talking about. So if it's a video discussion, I couldn't even tell what it was. So I gave y'all two. But you can actually resubmit that if you have a problem. So if you're not seeing that I have graded all your stuff, then make sure, because some of y'all said if it didn't upload, and I hadn't checked to see that yet. So I just want to make sure everybody know that as of now, as of 107 Eastern time on March the 5th, everything is, well, let me make sure I'm saying it right. Everything is, let's see, course, grade center needs grading. Yes, I am up to date. So y'all have everything that you need to go. Hey, Brandy, since I've already played the song, have we already talked about, did we talk about the retirement gamble yet? Does anybody know?
I think we did. Yeah, didn't we? Did we talk about it in class, or it might have just be the discussion zone, and I remember from reading everybody's discussion, but I feel like somebody else.
Well, I know the two Erics were here. Did we talk about this last week? The retirement gamble?
Maybe
No.
not actually.
Okay. Well, tell me what you thought about the retirement gamble, Brandy. We'll start with you.
Okay. Oh, I love the retirement gamble because it gave me a perspective. A lot of older people in my life have been really scared of um contributing to retirement funds like in my family, and I'm like, why are they, they're like people lost their shirts back in the day. And I didn't understand that being a millennial, and I've been contributing to retirement since my early 20s. And so I'm like, why? Like to me, it's more of a gamble not to do it. But after that, I have a lot more empathy for people that are older and scared of it and, didn't have the internet and saw some of their friends lose their shirts because of the, predatory fees and all the things. So I really enjoyed the documentary.
Okay, good. George, Inga, y'all got any comments on the retirement gamble at all?
I'm sorry, we were on mute.
Oh,
Um,
yeah.
you know, really, the we enjoyed it. The thing is, in the back of my mind, you got a plan for retirement, and we're there now. So um, but there have been a lot of nightmares. I've known of people that have had to that didn't they planned well for their retirement and they invested well for their retirement, but then just like kind of like what Brandy was talking about, due to the market, things shifted and didn't go the way they wanted it to. And I know of a lot of people that have had to go back to work because of that.
And how do you overcome that, George? How is there a way in hindsight, is there a way to have made sure that that kind of didn't happen?
Well, of course, it's all people have to understand that as you age, um, and we talked about it. One thing that stuck with me early on in one of our classes, and I think maybe you talked about it, or maybe it was on the Tasty Trade, one of the Tasty Trade webinars or podcasts, that we don't we don't deal with risk that well anymore. We don't teach our kids to take risk. We make them, they have to wear helmets to ride a bicycle and things like that. You you do you can't let risk rule your life, but on the other hand, you have to keep risk into consideration. Well, as you age, when you get to the age that Inga and I are at, you excuse me, at the age that I'm at, um, you kind of need to hold back, and as much as you would like to take risk and see things grow more, you got to be a little bit more conservative. And I think maybe those people who um, lost a lot of their retirement, maybe they were staying too risky at a later age when they should have been more conservative.
Yeah, you bring up a good point. And so this is what I kind of recommend to people, and let's make sure we're on the same thing. We all know that we love the S&P 500. That's kind of what I tell people. Put it in the S&P 500. And so for those that are in Vanguard, that's a VOO. And basically I tell people do 100% in that. Now, here's the thing. When you are 10 years from retirement, you are 10 years away. What I want you to do is now take 3 to 5% of your portfolio for each year for 10 years and move that chunk. So if you've got $100,000 in your chunk and you're going to retire in 10 years and that's the amount you got in there, then take 3 to 5,000 of that and put it in a total bond fund. And at Vanguard, I believe that's VBTLX. So that by the time you need the money, you are between 50 to 70% in market exposure, right? And you are between 30 to 50% VBTLX. Now, if you want to do further diversification for that, what we're going to show you is we've not got to it yet, but one of the upcoming portfolios that you will see is Ray Dalio's all-weather fund. So we're going to cover that, and it's going to have gold, and it's going to have some different things in there that are a little more conservative. But I still like having, 50% in markets and about half of that in bonds. If you're more conservative, you could do 70% bonds, 30% stocks, but I still think you need a little bit of growth in there. I think you need a little bit of growth. All right, Eric B., you want to talk to us about the retirement gamble? What were your thoughts?
Yeah, I liked it, but if you read my commentary, you'll also notice that I was somewhat critical, especially with Vanguard. I love their index products, but they're also out there advertising and selling actively managed products. Yes, their costs on those products are low compared to the average, but there are competitors out there for Vanguard that offer similarly actively managed products at a matching or lower cost. So I think as much as the consumer needs to take away from the overarching message from that article on Frontline, I also think that they need to be more aware as a consumer for what they're getting into. And I'll cite that I had a conversation with somebody this past week, and they were asking about like setting up a Roth IRA. They were younger, they were probably in their early 20s. And I said, look, just go to Fidelity, set up the total stock index fund. It's a zero cost fund. It's the same thing as it's very close to the S&P 500 in terms of what it holds. It picks up a broader exposure, and it is not going to cost you a darn thing. Whereas Vanguard on the investor shares is going to cost you 10 basis points. So
Yeah,
I didn't have any problem with Frontline. I think it was a great thing in terms of education, but I also think that what's the Latin phrase? Caveat emptor, buyer beware.
Yeah. And I think one of the big things that they were talking about is that fees were a big thing that people have to worry about too.
Yeah.
So certainly looking at fees, absolutely.
Well, they're huge, and the SEC has a calculator that you can actually run. It's either, I think it's SEC, it might be FINRA. One of them has a calculator that you can actually run cost comparisons on.
Good.
And it's
Good, good, good.
absolutely fascinating. So like if you take, I'm going to pick out American funds here because they they run the gamut of offering the high cost funds that are sold by a broker on a commission to the using the same fund in a different share class that actually is competitive and costs less than Vanguard. But if you go in there and you go into the calculator and you compare two funds, one that says has a front end load of 5% and an average expense of 1.2, and you do the same thing with like an S&P 500 index from Vanguard that's 0.05. Wow. And you assume the same rate of return on them, it makes a really big difference in terms of how much you see going out of your pocket and into somebody else's pocket.
Good, very good. Yeah, you're exactly right. Eric Hall, what did you think about the retirement gamble?
I thought it was great for information purposes, but I mean, I think just as far as making people aware that they need to be planning for retirement, and there's a lot of good stuff in there because I think the number one issue is lack of literacy anyway. I mean, it was kind of off-putting when the guy who's writing the majority of that, his dissertation and everything is like, "Oh, I don't know how to plan for retirement." I'm like, but aren't you like an economist, man? Like, it doesn't make sense to me. Um, and he's young, right? Like, one, it's just start. And two, I mean, I think the fear factor, they didn't help with the fear factor. And the fear factor is already there largely because in less than a generation, we went from pensions to having to handle our retirement on our own. And I think there just wasn't enough. Well, one, there couldn't be a knowledge transfer because that generation had never had to do it. And all of a sudden, you had a generation that had to take care of it themselves. Um, and so there wasn't a way to transfer the knowledge of how to do this, and you add the fear that naturally comes from the volatility of the market. I think that's one of the problems. I think the documentary might have just added on top of that by trying to scare the crap out of people about retirement and throwing out a lot of negative things about funds, and with the exception of this talking about Vanguard, not offering alternatives to a positive way of saying, hey, there is a way to do this correctly and safely to be able to retire on time.
Okay, good. Good. All right, Carlene, what do you have to say?
And there it is. Right there it is. Hi.
Hey, Carlene.
Yeah, and like Eric was talking about Fidelity, or Eric B was talking about Fidelity. My dad, who I think I've mentioned has been a financial planner since about 1980. He's a big fan of Fidelity too, Eric. But I think it has always felt, I guess, starting off working when you're younger, you it seems so, or it is so far away. But obviously, as we get closer, time can go by fast, and then all of a sudden you look and you might be halfway there already, But I think my dad has always instilled in me that there's so much time, and the market has always seen steady growth, and um, it it's just it is a weird, uncertain feeling. Sometimes the market feels confusing too because you don't feel like it's so tangible. And I think the uncertainty around what really is this and how does this really function. But I guess because we've been so fortunate that it has always increased. I mean, over time, it has, shown gains and everything. It seems trustworthy, but I still feel like overall it is hard to I guess in the back of my head, I'm always wondering, well, what if something does go wrong? Just because it's historically been a positive situation, things like that.
Okay, good.
Bobby, can I say something?
Yeah, Eric.
This is kind of an evolution of thinking that's occurred throughout this class, has dealt with how we think about the terms we're using in terms of, are we conservative? Are we risky? So on and so forth. I think at the end of the day, what most people are actually concerned with is not risk. They understand that if they go into the stock market, they could lose money or they could gain money. I think what they're mostly concerned with is exactly what you've been trying to do in your own portfolio, which is to hedge the volatility. And that is what makes them uncomfortable. It's not the idea that the stock market's going to go up or the stock market's going to go down, but trying to zero in on, well, first of all, trying to frame the conversation from the context of volatility and then using the art and science of determining what they're going to be able to be comfortable with and what they're going to be uncomfortable with, or what allows them to sleep at night and what allows them not to. So taking the example here, if you're going to do it as simple as an S&P 500 and a total bond index, maybe for somebody who is not comfortable with that level of volatility, putting their portfolio at half in stocks and half in bonds and moving forward with that, as opposed to talking about the conversation in the context of risk. Talking about it in terms of, yeah, you know what, this is going to be volatile, but there are some ways that we can cut back on the volatility. I still think that, a two investment approach that's broadly diversified is the way to go, or, maybe you cancel the S&P 500 and you use some kind of dividend paying fund that has less volatile stocks. But thinking of the context that way and framing it for the end user from that standpoint can help change their thinking and ultimately may change the number of phone calls that you get when volatility goes through the roof.
Okay, good. Very good. Hannah, you got something to add to the retirement gamble?
Are we just talking about the video we watched about it, like the movie?
Yeah, yeah. Just your thoughts about, are we in trouble as a nation with people not funding their retirement accounts?
Well, I'm 25 and I feel like, I'm not like normal people. Like I worry about stuff like that and I'm married and I'm trying to pay off debt. But like most people like my age that do have jobs and are employed, they have retirement plans at their work. So they're working on it, but I don't know how great they're doing in that process.
Okay. Does anybody in here think that it needs to be a forced savings? Kind of like Social Security, but maybe something different?
I'm adamantly opposed to that. I think the individuals should be capable of making decisions on their own, and if they screw up, then that's on them.
Yeah, I've got to agree with Eric. I think one, you lose efficiency anytime the government gets involved. And then individuals need to be responsible, but it also frees them to make their own choices because everybody's different when it comes to just kind of how they're going to want to invest and their risk tolerance and everything like that. So, and their needs. Like what I need for retirement may very well be very different than what you need for retirement, depending on what part of the country I live and what lifestyle I'm trying to have.
Um,
I have
Tim,
some opinion. Ain't we kind of already doing that with Social Security? I mean, I know it was not originally set up as a retirement, but really for the majority of the people, it is. Because I mean, the government saw that most people don't save naturally and don't think about saving, and then they understood that they would probably need some help when they get older, and they would probably, the government would have to foot that bill. So I think that's why they kind of like continued that Social Security requirement. So I think they're already doing that at some level.
I think
and
it's evolved to that.
I think the thing that burdens me is that it's money that's put up, but that the government is already spending it and they're not actually investing it so that you can actually have some returns based on the country's economic growth. They're trying to do it like a pension, but then they're not investing the funds. It used to be that everyone had pensions, and the pensions were responsible for the investments of the fund, and that they would then in turn pay over those investments as a defined benefit to the beneficiaries who had the retirement. And basically what we've done is said, screw that. That's not our responsibility. Let's give you an account to where you make the investment decisions and you do the money. So it's really it's I don't know. It's almost as if people have too many options, and because they have too many options, they don't do any of the options. It's really sad.
I just think that there should be so much more focus on the financial literacy side and introducing that as early as high school. I don't know why there's not more focus on that, especially since it's not news that people typically aren't good with finances. And I mean, as long as I can remember, I've heard how people's, retirement savings are not, near where they should be. And especially now that prices have increased so much since post-COVID. I mean, who knows if even we're prepared with what we've, historically saved so far because now I guess it's just, I guess I just assume it's going to cost even more than what might have been projected years ago, if that makes sense. So I think that it would not, I agree with what everybody's saying that shouldn't be mandatory, like as far as by the government, but it would be great if there was a huge push and, funds allocated to the education surrounding that, like what this class is about. I mean, obviously on a more starter level for other people, but, or for the general public, but I think that, oftentimes it feels like, I guess when you have, a whole entire country, things can be solved reactively. And it just would be great if things like this were taught earlier on in some type of a way that could kind of engage the masses. I don't know how that would happen, but
Yeah,
I think that would help.
I think that some sort of personal finance class is that should be mandatory in high school and if you go to college, be like that would be one of your quote electives. Because people, if they don't, first of all, most of the people probably don't know a lot about it, and second of all, since they don't know about it, their lifestyle is going way out of proportion, and they would rather spend $80,000 on a truck or something instead of putting that money back in retirement.
Yeah, good point. Look at this, y'all. If people just knew this, and I've shown you this calculator before, and yeah, I know that that this it's going to fluctuate. You may not get these returns or whatever. But let's pretend that if you have a baby in this country, right? You have a baby coming in, and either the parents, which would probably be the best way to do this, make it private. The parents would put away $1,000 for the kid, okay, at birth. Now, let's say that even you take this a step farther and you say, well, what if the federal government actually did this? Think about all the money they have to pay out for people for Social Security and all of this. This would probably be in the government's best interest to cover their costs for each kid. But let's say you took $1,000 per baby and you put this in an account, and you're going to, and it's a tax sheltered account that they'll create just for the kid. $1,000, length of time. Okay, let's do to the retirement age of 65. Well, now, first of all, there's going to be a lot of people that don't make it to 65. There's going to be people who pass away before that. You got to figure out what to do with that, right? You got to do something with that. But we're just pretending that we're controlling the narrative of economic policy in this country. If parents know this, or if the government assumes this, whatever, $1,000 per kid to help cover their retirement. And let's pretend now, and I know people say, oh, you'll never get this going forward. Okay, whatever. Interest rate of 10% if you were to put this into something similar, a total stock fund or a S&P 500, maybe get around 10% on that. What do you think this is going to be, Brandy? What do you think this will be in 65 years? $1,000, assuming we get the 10%.
Gosh, I mean, probably over $1 million, I would think.
Now we're never going to put another dime in. There's no
Never.
monthly
Okay.
contributions. We're just starting with 1,000.
Probably $1 million.
Okay.
I'll guess. I don't know.
All right, that's fine. $490,000. If you never put another dime in for those people. So now, what do you do? You know, if the stock market crashes in year 64, we got to worry about things like that. But the issue is people need to know, and they don't know about compound interest. You know, Albert Einstein said that compound interest is the eighth wonder of the world, time value of money. People need to know this. Well, wait a minute. You're telling me that I can make or potentially make $489,000 on $1,000 investment that I'm putting in for my kid? Well, yeah, assuming they don't take it out, assuming they don't close the account, assuming they don't, you'd have to put all kind of conditions and things on this money. But people could have a good part of their retirement, some of their retirement covered if they would only do this one thing. Now, I'm not saying that the government should do this for every child. Should a parent do this for every child? Well, it'd be great, but I don't think they know to do this. What is the parent worried more about with their kid when they have a kid? What are they more worried about funding?
Diapers.
Diapers. But what about something future for the kid? What are they more worried about? They're not worried about their kid's retirement.
College.
College and weddings.
College.
Yeah, college and weddings, things of that nature, right? So they're more worried about the 529 plans, things of that nature, for saving for their college. But to actually establish something for them to have at retirement would be an amazing thing. So that's just something to think about, right? So I want to talk now, moving on from the retirement gamble, I want to talk about different ways that you can approach investing. And there's three different categories you can do of analysis of investments, right? So there are fundamental analysis. Who can tell me what fundamental analysis is? If you're, evaluating investments, companies, stocks, and things of that nature, what is fundamental analysis? Okay, that's fine. It's looking at a company's balance sheet. It's looking at their income statement. It's looking at their statement of cash flows. I would also say that we could go even more broader than that and not necessarily looking at a company's numbers, opening the books of the company, but actually looking at macroeconomic. This would be more microeconomic, looking at an individual company, their balance sheet, their income statement, things of that nature. Fundamental analysis also would be like news. What is the CPI? Consumer price index. What is the PPI? What is the inflation? What is, all different things that you can look at. What are current interest rates? Different economics. You can look at GDP, right? Gross domestic product. And looking at the economy as a whole, basically fundamental is looking at numbers and news. Numbers and news. One of the sites that I like using, Eric provided a fund analyzer calculator, which is kind of cool. Yeah. Okay, good, Eric. Thanks for providing that. So
you're welcome.
Let me show you this. Let's see if I can find it. Let's see. One of the things that I use for fundamental analysis, not on individual companies, but basically on the economy in general, is financialjuice.com. And this is free. You can create you a little account. And basically, when it goes through the day, it's kind of cool. It gives you notifications too. White House Press Secretary Leavitt, reciprocal tariffs still going into effect April 2nd. And then if there's breaking news, U.S. waives 1 month delay of Canada and Mexico tariffs on auto. They'll put things like that in red, right? Trump told Trudeau the fentanyl efforts are not good enough. They'll do things like this. But this is basically looking at the financial news of the day It's looking at if GDP comes in or CPI or PPI or all of these things. You kind of get a running list of this information, and you can have it send you alerts and everything. I basically think that for the style of investing that we recommend over the long term, that this is trash. But it's good if you're doing some trading or on individual companies or things of that nature. So you need to know fundamental analysis. Okay. Any questions about fundamental analysis? The next one is quantitative analysis. Quantitative, I can't spell it, quantitative, is that it? Analysis. I'm not very good at spelling. Quantitative analysis. And quantitative analysis is where you put a probability to something happening. It's probability analysis. Well, if we are to buy a stock, what is the probability that the stock will go up and the probability that it go down? Well, it's really a 50-50 probability. So there's not really a quantitative edge that you can get there. The cool thing is with options, you can have a quantitative edge. For example, let's say that we want to trade, for example, NVIDIA. And we'll do trade and we'll do the table. And you want to sell a 43-day put at a probability of being in the money of 30%. So there's 33. So you sell, it's currently trading at 116. You trade the 105, you're going to bring in $415. And check this out. You have a 72% probability of making 1 penny or more in profit on this trade. Now you've got the probabilities in your edge. You are a quantitative trader. You have an 85% probability of making $210 or half of the premium on this. You've got an 86, 87% probability of success. If you simply buy a stock, let me show you this. So that's with options. You got 72% probability of buying an option. What if we buy the option instead of sell it? Okay. Here's why I'm an option seller instead of a buyer most time, because you only have a 28% probability of profit. Okay. But I can make a bunch of money, $10,000. I only lose $420 what I spend. But yeah, but you've only got a 28% probability of making money. All right, let's look at this. Let's clear this, and let's say we just want to buy the shares. So we click on the buy button here of NVIDIA. What's the probability of buying the shares? That's the probability that you're going to make a profit, 50-50. You don't know if that stock is going to go up or down. Now, you may have done fundamental analysis, looked at the books, the balance sheet, the income statement, statement of cash flows to see how well that thing's going to do. But really, there's no guarantee. It's a 50-50. So one of the things that I engage in is I don't engage in a lot of fundamental analysis. I engage in quite a bit of quantitative analysis, using probabilities and percentages in order to make my decisions. So for example, I drive to the gym each day. Now, if I wake up in the morning and go, wait a minute, there is a chance that I could be involved in a head-on collision on the way to the gym. And I could simply say, well, I'm going to stay at home and not take that chance. But there's a higher probability than not that most days nothing's going to happen. Now, I'm going to be just fine. I'm going to be safe if I drive safely. So using statistics, using probability theory, using percentages in order to make your decision. Now, I'm about to show y'all some fun stuff, okay? Now, this is fun, and this is going to, I'm almost scared to show you this because some of you may get carried away, and the next thing you know, you're going to be a degenerate gambler, and you're going to do all of this, so I'm real worried about some of y'all. But I think you at least need to be open and know that there is a world out there where these things can happen, okay? And the one that you really want to go down a rabbit hole technical analysis. Technical analysis. Charts and indicators. And as most fundamental traders would tell you, this is voodoo. Right? This is voodoo to these people. This is also voodoo to the quants. You're a quant, you're a fundamental trader. You know, these guys think these guys are nuts, insane. That this is basically a Ouija board when it comes to trading. All right. But you guys need to know that my friend who makes $10,000 to $20,000 a day, most days, uses technical analysis in order to make his decisions. And he's quite good at it. He's been trying to show me, and I'm not good at it yet. I'm working on it. But you have to kind of buy in that these technical indicators and these charts make a difference. So now he makes between $10,000 and $20,000 a day. Every now and then he loses money. The other, Beth is giggling downstairs, my wife. The other day, I said, "How did you do?" And he said, "I lost $100,000 today in a day." Right. And I'm like, well, you may want to choke that up a little bit. You may not want to lose that. But then the next day he makes 28,000. And then the next day he makes 45,000. I mean, he makes it back, but it's really, you know, this is voodoo over here. All right, so 3 ways to look at trades or to look at investments. You can depend on fundamentals, you can do quantitative, technical, or a combination of all 3, or a combination of 2, or a combination of, you know, you could do 2, 3, 1, or all of the above. So at least I think you coming into an investments class, you ought to know that, hey, we don't cover a lot of fundamental, but maybe you're looking at the books of the company. Maybe you're looking at the economic news, economic indicators, inflation, what the Fed is doing, those types of things, reading the FOMC meetings from the Fed meeting, right? All of that, fundamental. Quantitative is using the probabilities and probability theory in order to make your decisions, and then technical analysis. Now, y'all are going to laugh at what I'm going to show you here. But again, if you'd like to do a paper account and you've got some time, then this is a really fun thing to do. Okay. So this is charts and things of this nature, but that's not really what I wanted to show you. So let me do this. Let me move this. So on TradingView, I have set up some charts. And let me just show you. For day trading, again, what does this have to do with investments? It really is not investments. This is more trading than anything. And so what my friend does is he trades the NASDAQ 100 NQ. These are futures. You've heard of futures. And we like futures because they're highly leveraged. They don't take a lot of buying power for you to trade. And you can trade gold, you can trade oil, you can trade currencies, you can trade metals, you can trade silver, you can trade oil, you can trade natural gas, all kind of things that you can trade with futures. Well, these are NASDAQ futures. This is /NQ. And so I have basically a 5-minute chart. You see this. This is a 5-minute chart with 5-minute candles. You see a 1-minute chart. And you see a 15-second chart. Okay. And then
Dr. Gaines, are we supposed to be able to see your screen right now? I can't. I don't know if anybody else can or not. Are we supposed to be following you with your screen?
yes. Can you not see it?
Okay. Okay. I don't. Does anybody else see it? Is it just me?
I can see it.
We're seeing it.
Okay, they're seeing it.
I see it too.
So everybody's seen it but you, Brandy. I'm not sure how to direct you to see it.
I'm going to go out and come right back because it was just a little funny. I'll be right back. Go ahead, though. I can
Okay.
catch the recording.
So what I've got on here is some exponential moving averages. I've got an 8-period close and a 21 close. This looks at the last 8 candles. and basically does a moving average of those. So you can see if it's going down. And then we've got a 21-day moving average or 21 period moving average. We've got a CCI indicator here that basically tells me the strength of the move, how things are looking. So I've got that. Then I've also got, let's see if I can find this. I got so many things open. Okay, here we go. This is another chart of NASDAQ. And I've got some indicators in here that actually give a sell signal or a buy signal. This is kind of cool. A lot of times during lunch, you'll get chopped up if you're doing this. And then we've got a MACD. And you don't have to know what these things are, but you need to know that there are thousands of indicators that you can use to try to predict direction of an underlying MACD, moving average, convergence, divergence. We've got RSI, relative strength index, that's similar to the CCI that tells you whether it's a strong move to the upside or a strong move to the downside. So there's all different kind of indicators. And then if you really want to go off the deep end, my two Erics are looking at me like I'm crazy. You can open a trading account, a paper account with a broker that you can actually do what is called scalping. And so this is a broker with Tradeovate. And so you see, I'm not very good because I started out with $50,000 and now I'm at 38,000. So I'm extraordinarily horrible at this. I've done 24 trades today, and I was up nearly $1,000. I was up $1,000 yesterday. I was up $1,000 the day before. I was almost at $1,000 today, and one big news article took me out with that financial juice that I showed you. So now I'm only up $225 on the day. But what I basically do is, or my friend does, is he looks at this and then he goes over here and he makes his decision on whether to trade or not. So you see this. I want to make sure everybody knows it. This is what's called a DOM. Some people call it a dome. It's a DOM. This is depth of market. And this is the current price of NQ. This is the NASDAQ 100, right? And you can see the yellow. I'm having to scroll to get to where it's going, but the yellow is the current price. What you see in red are the number of contracts that are being put in to sell. The numbers on the left are buy contracts. You can see there's 10 contracts stacked right here. It just got taken out. Price is going down, right? So this is kind of interesting to see that price moves so quickly in NASDAQ. If you want to trade something that is less volatile, this is something very boring. This is the S&P 500. Look how slowly it moves. There's 141 people or contracts that a trader or multiple traders have put in to sell the underlying at 58.23. There are 49 people who are willing, or 49 contracts that are being offered here to buy the stock or the future at 58.19. Isn't that crazy? So what my friend does is basically he looks at these charts to decide which way the price is going. So the first thing you would do is you would look at maybe an hour chart. These are candles from the last hour, or not from the last hour. Each candle represents an hour. The position, this is going up, this is going down, now it's going back up. It's kind of sideways, right? Over the last, let's see, this was March the 3rd at 6 o'clock. And this thing is just kind of going over like this. Then he would say, well, I'm going to look at the 15-minute chart. Well, the 15-minute shows you that clearly this thing is now in an uptrend. And then he goes down to the 5-minute chart, and the 5-minute chart says we were in an uptrend, we're taking a little bit of a break, and now we're starting back. So it's just a kind of a fun thing. If you wanted to, this is TradingView. You can open up a free account with TradingView, and you can do all kinds of different charts. For example, one of the things that I use is this. I like looking at the S&P 500. This is a linear regression. You see the blue and the reddish here. That's a linear regression. Each one of these candles is a daily candle. So the overall trend of the market, as you can see from the slope of the linear regression channel, is up. However, we have been going down, 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 down. Why? Because of something fundamental. What is the fundamental reason that we're going down? Anybody know?
Stagflation fears.
We don't like the tariff talk. We don't like the tariff talk. The market is uneasy about Trump's tariffs. I believe that is the number one reason that we're seeing this. So what we were doing here is the market was like, I don't know about this guy. What's he going to do? What's he going to do? I'm undecided. I'm undecided. I'm undecided. I'm undecided. I'm undecided. Oh crap, we're in trouble. And I think it's because they don't understand what he's trying to accomplish with this. So let me talk to you about a candle. This is a candle. As you can see, it has a very small wick at the bottom and a very small wick at the top. So this is a red candle, which means price started at the top of this red body. Let's see if I can zoom in here so you can see it. Price started here at this level. It got as high as this level. See the wick there? But sellers pushed it down, and they pushed it all the way down to here. Then buyers came in and ended there. This is a down candle. Right? This is an up candle. Price started on this candle at this level. It got as low as this level, but sellers came in and bought it up. And this candle then went upward all the way to here before sellers pushed it down to here. And this is where the candle ended on the day. So this is a graphic representation. These are called Japanese candles of how a stock is doing. Now, these candles can be as big or as little as you want it. As you see in, this is what I use with, this is a 2-minute candle, right? This is the E-mini S&P 500. This is that was the S&P 500. Let's see the NASDAQ. These are the NASDAQ over here. Generally, ES leads. This is the leader. The S&P 500 leads, and normally the NASDAQ follows. Look how similar the candle patterns are for the NASDAQ compared to the S&P 500. It's really amazing. Even though this is up only 0.63%, NASDAQ is up 0.80%. Okay. So I don't want to get you into a gambling thing, but I do want to at least show you this so that you're aware that many of your clients are doing this for a day. This is what the government workers are doing that are working from home, right? I mean, they're doing this while they're supposed to be doing their job. Wink, 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 wink. So for example, there are those that say this is a doji. You see there's a very small body and there's a wick on either end. They would call this a doji or an indecision candle. All right. This is an indecision candle. This is an indecision candle. And then the market finally makes its mind up that it's going to go down. Now we're forming another doji. The market's indecisive. There's not a lot of movement on the actual body. We're down a little bit, but it went down all the way here. We went up all the way here, and then we're back here. That's cool stuff. So let me show you this for you again. Okay. So let's go back to this. It looks like the market is going up. Let's play a little bit. Okay. Now this is playing, and this is not actually a trade that I would take, but I want you to see how I would do this if we were actually doing this in the real world. Okay. So we're in an uptrend on the 15-second candle, and the market just went down. Let's pretend that I'm going to buy. No, I don't do it on the ES. I want to do it on NASDAQ. I'm going to buy 2 contracts. Okay, so I've got a limit order waiting here. We did not get filled. Okay, so I've got my order waiting here. Price is all the way up here. And let's see if we get filled. And again, keep in mind,
Order filled.
Order filled. Okay, now I'm going to go up here and I'm going to sell at the 25.70. We're up $130. I'm going to put a stop right here. We cannot lose money on this trade. Now we're up $80 on the trade, on the current trade. We're up $80. We're up $85. We're up $125. I'm going to move my stop up. Okay, we're up $185. We're up $200. And we're probably going to get stopped out here. So we're up 165.
Stop filled.
Stop filled. So we went from, what was I, up $225? We made $170 in that amount of time. This is why a lot of people do when you hear day trading, okay? They basically say, I'm going to pick a direction. It's clear to me that the stock's going up. This is positive. Cumulative volume delta is positive. Everything looks positive. And then I would simply wait for price to come down to me so that I could participate in the up move. And you can sit here and do this all day. Now, there are people that believe that they know how price moves. And so they have seen these patterns over and over and over and over again. And so what they do is they take a chance and they'll put in an order to buy or to sell. I could easily sell on this side over here. I could put an order to sell over here. And then you can put a stop loss in to protect yourself. But this is how people, a lot of people are doing it, because you see these people are trading right now. They're all putting these orders in and it's taking price. Look at their higher. We should have stayed in the trade. We knew that it was going higher. We were in the trend. We waited until price came down here. Price went up. We made $170. Questions? Eric Hall, you look like you're overwhelmed here. Isn't this a lot? So this is something that you're not going to be doing with your clients. It's something that if you do, I would say just do it with a couple of play accounts here. If this is too much for you, like for this going, let me show you how quick. From it going 1 point, from 87 to 86 is $20 per contract. It's $20 per point. If that's too much for you, you could trade something that's called MNQ. MNQ, which is the micro, which is 1/10 the size. That may be a little better for somebody if you had a small account. And so let's say that I think that the trade's going to go down. And if it gets up to here, I'm going to sell 2 contracts at the 96, 25.96. Let's see if we get filled. Come on, baby, hit me. Hit me, hit me, hit me. And then let's see if it falls down. Here we go. So now I'm trying to short the market. It's not going to come up and touch me, is it? Come on.
Order filled.
Order filled, and we take our profit of $41. I've got a stop in here for 1 contract. We're up $47. We're up $50. We're up $40. Let's take it.
Order filled.
Now we're up at $441. Questions? This is called day trading or scalping. It's not really an investment, but it's something that you need to know that's out there. You need to know candles. You need to know charts. You don't really need to know moving averages. You don't need to know necessarily volume. This is the amount of volume, the number of trades that were traded at each candle here. But it's just an interesting thing. And you're welcome to go to tradeovate.com set you up a free account, and they give you $50,000 free, and then you just get in here and trade. And it's really remarkable to sit here and watch this and see the movement of the market, trades going up, the price going up, price going down, and then trying to pick a direction. But basically what my friend does is he lets price come to him, right? If we're at 25.70 now, he says, well, heck, I get over here at 25.80. I'll put me in 2 contracts. I'll let price come to me, right? And then I'll get filled, and then I'll take the profit. So let's see if price comes to me. It's almost it, and boom.
Order filled.
Now all of a sudden we lost $27. Now you're down $50. Exit,
Order
let's get out.
filled.
We took a loss. Now we're back down to 370. But I was just playing with it to kind of let you know that this thing is out there. Okay, this is called scalping. It's called day trading. You can do it with anything. You can do gold. You can do crude oil. You can do the euro. You can do silver, natural gas. There's so many things you can do. So you at least need to know that this world exists. Any questions at all? No questions? All right, guys. Good session today. Enjoyed speaking with you. Hope you have a great day, and I will see y'all next Wednesday. Or when is the spring break, y'all? Do you know?
Next week.
Is it next week?
Yep.
Okay, so we will not see y'all next week. So we got spring break next week, so I'll not see y'all next week. I'll see y'all the week after.
We'll see y'all on the beach.
There you
Okay.
go. That sounds good. Bye, y'all.
Bye.
Yeah.